Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, lecturer finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is BS 251. However, according to old scheme of study, the course code for same subject is MS 251. This is our lecture number 15. And the topic for today's discussion is valuation of preferred and common stocks. The outline of this lecture consists of the discussion related with what is a preferred stock, and then we will look for an example consist of valuation of preferred stocks, that is how to calculate the intrinsic value of a preferred stock. The discussion will continue on with what is a common stock or a common share, and then an example will explain how to value the common stock. Let's discuss our first agenda, that is preferred stock valuation. Now, what is preferred stock? It is a type of stock or share that promises a fixed dividend but at the discretion of board of directors. So the first characteristic is that the board of directors will decide to pay out fixed amount of dividend on the preferred stocks. Why do we call this stock or share as preferred stock? Because the preferred stock has preference over common stock or common share in the payment of dividends and as well as claims on assets. So the holder of preferred share has preference over the common share for the payment of dividend and as well as claims on asset in case of liquidation of the business. The claims of the preferred stockholders will come first, then the common shareholder. This is the reason this share is known as preferred stock or preferred share. How to value preferred stock? So the simple formula looks like the bond valuation case. However, certain notation will change in this scenario. Basically, this lecture is in continuity to my previous two lectures. So I strongly urge to the listener of this lectures to go through from previous two lectures in order to have full grip on this lecture. So the formula says that the value or intrinsic value of the preferred stock is equal to discount the dividend over the preferred stock to timeline 0 or time t is equal to 0 or t naught, and then subsequently discount the second year's or second time period's completion's dividend and bring it back to the time 0 by discounting it with the relevant discount rate, so on and so forth up to infinity. Because this preferred stocks never matures, this is why this resembles with the situation of a perpetual bond. We can summarize this formula by writing down this summation symbol. It start from 1 up to infinity, and then to discount the preferred dividend for infinity time period, which is not possible. Or another way around, we can also use the table method by finding out the present value interest factor for annuity at a certain discount rate of preferred stock for infinity time period, which is not possible. So therefore, keeping certain assumption into consideration, the final version or the final formula we derived for discounting or calculating the intrinsic value of preferred stock is V is equal to preferred dividend divided by the discount rate for preferred stocks. Let's take an example to understand this formula. Stock PS, named as preferred stock, has an 8%. This 8% is the fixed amount of dividend the company is going to pay to the holder of preferred stock, and its par value is $100. Issued outstanding. Outstanding means that this stock has been sold out by the corporation and somebody is owning or possessing this share. And the question says the appropriate discount rate is 10%. And finally, the question asks us to calculate the intrinsic value, or what is the value of this preferred stocks. The formula was V is equal to dividend divided by discount rate for this preferred share. So we need to calculate first of all the dividend payment on this preferred stock, which is to multiply 8% fixed amount of dividend with the par value. Therefore, we come up with $8 of preferred dividend annually. The discount rate is already been given in the question, which is 10%. So therefore, now we can plug the relevant values into the formula, which is V is equal to dividend divided by the relevant discount rate, and hence we done the same. 8 divided by 10%, and 10 needs to be transformed into 0.10 in order to remove this percentage sign, and then to divide 8 by 0.10. The final intrinsic value of this preferred stock come up with $80. Now the decision criteria is if somebody is going to, or a corporation is selling out this preferred stock at a price of 80, you may purchase this stock. But if somebody or corporation is selling this share well above $80, then as an investor you should not purchase this stock. Now let's discuss common stock valuation. Before calculating the value for common stock, let's define it that common stock represents a residual ownership position. The residual means the leftover ownership position, like when all the claims and all the obligation due for the corporation has been fulfilled by the company, and if after fulfilling those all the obligation by the company, the leftover amount, which is known as the residual amount of earning, may be distributed amongst the common shareholder with the discretion of board of directors. Here, pro rata share of future earning after all other obligation of the firm. When all other obligation of the firm fulfilled, only then pro rata share of earning shall be distributed amongst the common stockholders. And secondly, the dividends may be paid out of pro rata share of earnings. Now, if let's suppose the company has decided to pay out dividend to the common stockholders, so the leftover amount after fulfilling all other obligation will be distributed amongst the shareholders depending upon the ratio of investment into the total capital stock. So let's suppose if an investor owns 5% of the stock in the total capitalization of the company, then let's suppose $100 million or $100 has been decided by the board of directors to be distributed among the common stockholder. If somebody own only 5% shares, then he or she will be awarded with $5 or $5 million dividend. So the pro rata share of earning distribution means whatever percentage a particular investor hold in the company, according to that percentage, the profit shall be divided amongst the investor. So what type of cash flows shall a shareholder receive when owning shares of common stock? It's twofold. Number first is the common stockholder may obtain future dividend when the board of directors may decide or may announce dividend payments for common stockholders, and secondly, the future sale of common stock when investor is going to sell out its share in the stock exchange after holding for a while or for a number of years. That amount could be realized by the investor. So either the investor is going to receive dividend or the future sale price of that share. How to value such kind of common stocks? So the basic dividend valuation model assumes and accounts for present value of all future dividends. So once again, it looks like the valuation process for preferred stocks. So V is equal to dividend for the time period 1, dividend for the time period 2, and so on and so forth up to infinity, which is not possible to discount all these dividend payments to time 0 in order to calculate the value of this stock at this time period. Therefore, we got a reduced version in these subsequent slides. Another way around, we can also write down the above formula in this shape, like t start from 1 up to infinity, and then to discount the given dividend up to time t with the relevant equity investors required rate of return. Here KE represents the equity investors required rate of return, and div subscript t represents the cash dividend at that particular time. Let's discuss what is adjusted dividend valuation model. As we know that to discount the dividend up to infinity time period is not possible, so we assume that an investor is going to sell out this common stock after holding for number of time periods, like for 2 years, 3 years, or 4 years. So the basic dividend valuation model may be adjusted for future stock sale. Like after 3 years, let's suppose the investor is going to sell out this stock, then in this condition, valuation is quite simpler and easy. Like V is equal to dividend for time period 1 and then divided with 1 plus ke raised to the power 1. Then put a summation sign. Second time period's dividend. Then to discount it with the equity required rate of return 1 plus ke raised to the power 2. Similarly for dividend 3, if investor is going to sell out this stock at time 3, needs to be discounted with n raised to the power 3 over here. And then definitely the price of the shares shall also be realized at the end of time period 3. So it may also be discounted back to time 0 in order to calculate the value for this stock. Here n represents the year in which the firm's shares are expected to be sold. Like in our case, we have obtained 3 number of time period to sell out this stock, and price represents the expected share price in year 3rd. If the number of time period is known, we are going to adjust the discounted dividend discount model and can simply calculate value for such stock. However, in case of a perpetual condition or up to infinity, we are unable to calculate the value for such stocks. Let's discuss some other assumptions for valuing the common stock. The dividend valuation model requires forecast of all future dividends, which is not possible. The following dividend growth rate assumptions are really important to simplify the valuation process. There are 3 assumptions in the dividend discount model or dividend valuation model for common stock. One is known as constant growth. Second one is when there is no growth in the dividend. And third is growth phase model. Here, particularly in this lecture, our emphasis will be on constant growth model. However, the next 2 assumptions will be discussed in the subsequent lecture. Now, what are these assumptions all about? By constant growth, we means that we assume that the company's dividend is going to grow with a particular rate known as, or symbolically we represent this growth rate by G. Let's suppose we assume that the company's dividend will grow by 5% each year. So when there is such kind of a constant growth rate, this assumption is known as constant growth dividend discount model. Let's take an example to elaborate it in more details. What is a constant growth model and how to value such common shares? The constant growth model assumes that the dividends what the company is going to pay will grow forever. This dividend will grow forever at a constant rate named as G. So in this case, the question will provide you or furnish you with the current amount of dividend denoted as D naught. Let's suppose if the company's current dividend is $3 and its constant growth rate is, let's suppose, 5%, so we can simply find out the next year's dividend named as D1 by multiplying this 3 with the growth factor, which is 1 plus G. 1 plus G over here is 5%, which could be written in this fashion, and raised to the power only 1 because we are going to find out the factor or the dividend in the subsequent year. So in this case, the D1, which will be termed as the next year's dividend, will be $3.15. In the same fashion, once again, this dividend will grow in the next year. We can denominate it with D2, and this dividend will once again will grow with the same rate or same factor. Therefore, it is known as the constant growth model, and the next year's dividend will be 3.15 multiplied by 1.05, and it gives us 3.3075. So in the next year or at the end of second year, the company is going to pay out $3.3075 of dividend per share. So this is the way we can calculate the growth in our dividend, like value is equal to D naught into 1 plus G whole divided by 1 plus K e raised to the power 1. We have to discount it towards time 0. Similarly, we can discount the subsequent or second year's dividend, so on and so forth up to the up to not up to of infinity, but up to, if n is given for us like n is 5 years, then only then we can calculate with the help of this formula. But if the situation says that the dividend will grow forever up to infinity, then the situation becomes a little bit complex one. In that case, we have to reduce the above formula into a reduced version of valuation, or reduced version formula for calculating value of constant growth common shares. And the formula says to divide the next year dividend, which is D1, by KE minus G. Here D1, as earlierly I have explained that D1 is the dividend paid at time 1. G is the constant growth rate, will be given in the question narration, and KE represents the investor's required rate of return. In the next slides, we'll have a solid numerical example to explain the constant growth model for calculating the value of common share. Here it is an example of a constant growth model. The statement states that the stock CG, which is referring towards the constant growth, has an expected dividend growth rate of 8%. So the G factor has been given in this question's first statement, which is 8%. And then the question says each share of stock just received an annual dividend of $3.24. So this, dear student, just focus on the word that just received means that it's the current time period, like D naught. The D naught in this case is $3.24. And then the appropriate discount rate, which is KE in this case, is 15%. And finally, the question asks you to calculate the value of this common share. So the procedure is very simple. We had a formula which is over here, like value is equal to D1 divided by KE minus G. And the relevant data in this question is being given, which is G is equal to 8%, D naught is 3.24. Therefore, we can calculate D1 in this fashion. Just look over here. D1 is equal to D naught multiply by 1 plus G factor. Therefore, the D1 in this case come up with $3.50. So now it's very easy to plug the relevant data into the previous formula, which was D1 divided by KE minus G. Therefore, we can do value of this constant growth common stock is equal to D1 divided by KE minus G. So we can plug the data into the relevant position. D1 divided by KE. KE was 15%. So in order to remove this percentage sign, we have to divide 15% by 100. Therefore, the resultant value after removal of percentage sign is 0.15. And similarly done for this G factor, which was 8%. Let me remove this ink. After plugging the relevant data, D1 divided by KE minus G will give us the value for this common stock, which is constant growth common stock, is $50. So after calculation, the final value what we have obtained by applying certain assumption and this formula, the value of this constant growth common stock is $50. Now it's important for investor to know about how to calculate or how to find the intrinsic value of the common stock, because the investor is usually interested to put the precious money of his into certain investment opportunity in order to earn the profit. So if the company or someone is selling this constant growth common stock well above $50, like on $55, then the investor will refuse to purchase this stock on this $55 because the actual or intrinsic value of this stock is $50. However, if somebody is selling on $50 or well below $50, like $40, then the investor should immediately purchase this common stock having constant growth assumption or constant growth nature, and can subsequently sell out this stock on $50, which is the intrinsic value, and can obtain an immediate profit of $10. So the basic purpose of valuation is to have the decision either to invest your money in this common stock or not to put your money. Thank you very much for listening to this lecture. If you have any confusion or question related with valuation of preferred stock or common stock, you are free to ask on KCMS, or another way around, if you got any problem, you can simply email me on my official email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.